Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, June 5th, 2025. It's 11:22 a.m. Eastern Time. So I'm starting the video, so we're a couple hours into the trading session. Here's what I'm going to do in this one. I'll try to do it in this order. I'll just a ever so brief update on the equity markets. We're still in those trading ranges. But what I want to point out, and I have been talking about recently, I think the biggest thing to watch right now, well, there's a lot to watch. I'm sorry. Treasuries, obviously, I've talked about that. We've come back off those the 30-year testing multi-year highs recently. So like I said, right now we're okay because we pulled back there. Plus the charts were constructive for a bounce with the positive divergences at those lows that I highlighted. And however, again, we're in spitting distance of new highs on treasuries. Market is most certainly not seemingly concerned about that. And again, it's until unless they break out to new highs, it hasn't done so. It tested and pulled back. So, but again, it could just be one or two bad days to get us there. In other words, with a spike in yields. But let me just show you the things that I'm watching right now that I think will determine the near-term trajectory of the market. In other words, will the stock market punch out to new highs, make that marginal new high, which again is just coin toss odds right now, in my opinion. There are three things other than treasury bonds that I'm watching right now for that. And that is, of course, the unknown. What I mean by that is we've seen just a lot of random things hit. We know Trump is a loose cannon as far as on today, off tomorrow, with his whole, taco trade thing. And the markets are starting to learn that he is a bunch of hot air and he will cow down. So I don't put too much into that, although there's just a lot going on right now, also with his big bloated bill. So what I'm going to say there is the unknown. There's an unknown at any point in time, really, but more so right now because there's just a lot going on the economic front. So let's just kind of shelf that because you can never trade around unknowns. The other thing is China. I commented on that. I commented the Chinese are not, the Danes. They're not this polite country. The Chinese are, will go toe to toe with Trump. Trump is he tries to be a bully. He's certainly an egomaniac, and he's thrown out, and he's lost, I think, a tremendous amount of credibility lately with that whole taco trade mocking him. He's familiar, and I give you my thoughts that I think he is now, because of his ego, a lot less likely to cow down at this point, only because he's eaten so much crow lately and he's being mocked out there. And again, with somebody with a big ego like that, that usually will cause them to then hunker down and so we'll see. So I think he's less likely to yield. But as I pointed out recently, and with the assistance of one of the members on the site, China, we don't hold, Trump was cocky early on. You heard him say it directly that China needs us more than we need them. That we're the two biggest economies in the world. We're intertwined, but I said that's BS. We're just as reliant on them as they are their cheap goods and other things. And China now knows rare earth magnets, something as simple as rare earths, metals, can actually put the U.S. completely bring the U.S. economy to a halt. And that's what China's been doing is effectively just dragging their feet on the permits there. And so we're already seeing, actual and potential additional impacts. Actual meaning, as that one member posted, they're already shutting down around the 4th of July just because it's too late now for the rare earth magnets they need for their industry, for their business. There's no way they're going to get here in time. So, and again, that was then further reported in the Wall Street Journal I covered yesterday. So what I'm getting at there is China, that's a big wild card. I thought I heard that Trump and Xi were on a call today, a call initiated by China. So we'll see where that goes. And again, that is something, I'm just giving you guys the facts that these are big events right now. And, anything that the markets interpret as clearly positive will have the potential to pop us to new highs. And anything that would be clearly negative certainly has a potential to go the other way. Like I said, it's priced in the charts. We have divergences that have been building. I've covered that recently with other trades. Sometimes those build. You get the little shot across the bows, corrections off each divergent high. But when they get bigger and bigger and bigger, they ultimately lead to a major trend reversal. Again, not always, but much more often than not. And that's all I trade in is probabilities, not possibilities. So to me, it's just a matter of it's kind of a little bit obscure in the near term. Can see the potential for a new high just as I could see the potential, almost equal odds of us falling short of that. And I do think it'll be a catalyst. Now, the third, remember, the first was unknowns. Can't really, like I said, unknowns are always there, but right now I think a little more than elsewhere. China is everything. Again, there's other countries that were on and off with the tariff thing, but China's a big one. We all know that. But the other big one that I've been talking about is employment. And that's why I start out here on the economic calendar. So we had just the other day, yesterday, ADP employment missed by a mile. Consensus, as I think I covered already, was about for 110 new jobs, private payrolls created. Came in at and the range was 70 up to 180,000. Came in at 37. Now, given that's a month-to-month number, one data point, just like I always say, one good or one bad day in the stock market does not make a trend. But when you connect the data points, and so again, it's something to monitor. And in that, so we had go back to the calendar, which again you can access on the homepage of the site. Go to resources and then tools of the trade. So today we had jobless claims. Those also came in hotter than expected, actual 247. The consensus was for 235. And it came above the consensus range, which was from 230 to 243. So I'm seeing that trend that I've been talking about, and it's in the unemployment data itself. The jobless numbers nationally have clearly been trending up. Again, I covered that in detail yesterday. Check that video out. And so here's, again, in the near term, the catalysts that are going to make or break the rally will be tomorrow. We have our employment situation. This is going to be a big one. My preference is to sit tight on any positions related to anything that could move. In other words, things that are correlated to the stock market. What I mean by that is, I gave you a couple trades recently that have no correlation to the stock market. I gave you yesterday, what was it? OSCR. Okay, so OSCR it's not highly correlated with the S&P 500. It's a nice lift today. We're about halfway to the first target one day. We're up 14.5% right now, coming a little bit off the highs. We're up higher than that. And so like these trades, I wouldn't trade around or put too much of a weighting on what's going on with the trade wars and things like this, okay? And then, of course, VERV, virtually zero relation. You can just look at the chart and see that it has absolutely no correlation to the U.S. stock market. And so that one's going to trade on its own. So there we are, just that first target today. And so that's it. So reactions, or odds for reaction are elevated. And if and when we take out T1, then we go up to T2, then T3, and I give you these all potential targets if that trend line's taken out. So those are all still potential longer-term targets with the last official target up here about $9 in that downtrend line. So those, again, nothing to do with the stock market. The S&P 500, the NASDAQ 100 absolutely have everything to do with the stock market. And so on that, my plan is to, not do anything, sit on my hands until tomorrow, because that's going to set the tone. If job numbers come in good or better than expected, absolutely that helps support the case for a rally. And remember, the market can do funny things. You could have a big miss on the job numbers and actually see the stock market rally only because the odds for a rate cut go up. And again, it is my prediction that we're going to have those rate cuts and then we're going to see things turn. But at the end of the day, and I've covered this in the past many times, you can research the statistics. There's not a thing in the world the Fed can do. When the job market turns, has clearly turned the corner, and once that uptick in employment really begins to accelerate and it becomes clear to most. Right now it's clear to me, but it's not clear to the masses that the job market's turned. At that point, it's called the point of recognition. A recession's almost inevitable. It builds on itself. It's a vicious cycle. Companies will, further lay off, less hiring, consumer spending starts to go down, and then the recession comes, and then the stock market will start to really price that in, especially if it's behind the curve on it, which I believe it is here. So again, tomorrow it's going to go either way. And so my plans: sit tight on these positions. If we go up any more, yeah, marginal new high, as I've talked about, could be, it could be 1% or a fraction of percent, or it could be 3, 4, 5, 6%. Probably somewhere not much more than that is my expectation. So now you may not want to ride that out. And again, the short-term swing trade on QQQ, like I told you, we already hit the first target and then bounced there. So the initial stop that I gave you was only for the first two targets. So that one would be extended higher for those of you targeting any of the deeper targets. I've made that clear many times. So I had a stop on I think it was on a daily close above 532. We're pushing that now. But this is a much higher, again, if you cycled in here, if you took profits there and recycled back in at a higher level, or if you're holding out for one of these two targets, then your stops are going to be wider to allow for still a favorable RR for the bigger downside there. So that's the update on that. And let's go back to that economic calendar. Oh, there it is. I had it open. All right, just take a look. This is what the market will be looking for. Non-farm payrolls month over month. Looking for a consensus of 129,000 new jobs with a range of 100,000 to 190. These come out at 8:30 in the morning, so it'll be most likely some movement here in the markets, unless it's kind of splits the crosshairs and we come in around consensus. It could be a non-event. Unemployment rate, 4.2. That's what they're looking consensus. Private payrolls, you could check it out. So let's see what happens tomorrow. Again, I believe putting anything else that comes out of Trump's mouth or on the economic, the kind of the unknowns, the very fluid situation with the trade wars, this will most likely determine the near-term direction. In other words, where the market goes tomorrow and where it goes next week and in the next couple weeks here. So it's that simple, in my opinion. Good numbers there. As good or better than expected or close to it, the market can rally. And if it's a big miss, like I told you before and I showed you yesterday, when you start to see that turn, which we've clearly seen in the national unemployment numbers, you hit a point where it really begins to accelerate. And so far, it's been relatively benign numbers, so watch that. All right, I don't want to beat a dead horse. That's what I think is other than, of course, Treasury yields. But as of today, like I said, we have a little room there. So this in the very near term is what I think is the most likely to move the markets. And that's that. Let's toggle over while I'm on this. Let's go to wheat right here. Talked about this and many times. This is my long-term chart of wheat. It's a weekly chart. Let me change up the color here so you can see it a little better. These are the continuous futures contract. This goes back to 2000. So this is really the late 90s right here. Big divergent low, aka positive bullish divergence. Ended a secular bear market in wheat prices and started this new multi-decade uptrend line, again starting from the early 2000s right there, right around the beginning of the year, and we're already in 2025, so that's a quarter century uptrend line. I talked about it here. I've been longer term bullish on wheat for a good year now since we hit that trend line, because we had positive divergence, and that positive divergence, as I said it would back then. Remember, if you look at some of the posts going back on these videos covering this going back for the last 6 months or so, I had dotted lines here showing you, and I made them solid today. I finally turned them to solid lines, showing you that any equal or marginal new low anytime soon would only extend the existing divergences. Bottom line, nothing's changed in that technical posture. And as I like to say, support is support until unless broken. So we're still at support and we're still pushing that downtrend line, which gives us that big falling wedge. And so my price targets for wheat are long-term. And this is both a swing trade setup and a long-term trade setup. You can buy it here at support with a relatively tight stop. Again, relative to what? To the scope of the move. What is the scope of the move? Let me go here. Annotate. No, not annotate. I want to grab this tool right here. And off that trend line, my first target is going to be a move of a gain of about 53% in wheat. My second target there about 87, and my third and current final target about 162%. So if you are in agreement with any of those or all those numbers, then your stop will be commensurate with those price targets using a favorable R. In this, I'd say at least 3 to 1. You can even do a much better 4 or 5 to 1 RR, and that gives you a little bit of room. It gives wheat a little bit of room if it wants to have a little punch down through there. Okay, if it wants to punch on down through there with a little false breakdown, and anytime sooner it'll keep those divergences intact. So just like the stock market in reverse, any marginal new high anytime soon will still keep the divergences intact. They're not the be all end all, but they are a big part of my trading. I've been trading wheat for years. You can go back on the site and see these trades back many of these previous divergent lows and divergent highs where we went long or short wheat. It's again, I speak in probabilities. The probability is after a divergent low with oversold conditions down to support, which is what we have here, increases the odds of a trend reversal. And sometimes those things come right away when you get your first divergent low and your first oversold reading, and sometimes they take a while. And that's it. So it's like any other trade. I don't get a lot of comments on the most. 99% of the comments come in the markets. It tells me 99% of the people most people out there are only trading the stock market, and that's one of many trades. Just like wheat, you don't put all your eggs in one basket. And what I like about it too, and I always say this, is trading various commodities, which we do here. Everything from wheat to corn, soybeans, crude oil, natural gas. The metals, the miners, the metals, I should say, the miners are equities. Those are all different types of commodities. And at any point in time, I'm usually quite often long one, short the other, because they have no correlation to each other. In other words, wheat doesn't have any correlation to gold, and nor do gold or wheat have any correlation really to the stock market. Okay, then zooming down to the 60-minute chart of WEAT, which is the ETN that tracks wheat. 1 hour chart gave you that divergent low recently, breakout and back test of that first minor downtrend line, giving a buy signal, then a breakout and back test of the secondary primary on the 60-minute chart, primary downtrend line. And remember, we're at the downtrend line on that long-term weekly chart right now. So although this is a little 60-minute chart, we've had plenty of shorter term swing trades here that played out on the 60-minute time frame. However, if we break out of here, and I give you that potential inverse head and shoulders bottoming pattern as well, with the neckline here, which aligns with R3 roughly, that means third resistance level. And if this trade starts to get some traction, in other words, heads up to T2, T3, we're then going to be above that long-term downtrend line on the weekly chart. It's going to open the door to the longer-term targets, as I mentioned here. Solid break above T4 will likely open the door to those longer-term swing targets. So again, just one of many trades out there right now. There's a near-term uptrend line, and you also have R1, S1 means first support. Yeah, you have reaction lows now established a little below that support zone. So, you could have a relatively tight stop here, a little bit below 450 if you're in that one. Or, again, if you're going for the prize, long-term targets on the weekly chart, I already addressed where those stops would be, much lower for a long-term trend trader or position trader there. Okay, that is wheat. Natural gas. Let's just talk about nat gas and crude oil. Okay, so just recently crude was down here. We had put in a divergent high, or we had put a divergent high in here. I highlighted it's been in this trading range right here, boxed by these lines right here, bouncing around. We had 2 periods where it was below that trading range recently, but most of the trades in recent months have occurred here. And told you I was leaning towards, and again, my convictions weren't that strong then. They're not that strong, that much stronger right now. But we were right here, and I told you I was leaning towards one more pop up towards the top of the range, put in an even bigger divergent high. In fact, those are the lines I had drawn out, extended these lines. And so far that's playing out. If we can get a little bit higher, ideally even a pop above, and talked about how crude oil and natural gas tend to be inversely correlated due to production the production of natural gas and crude oil. Pumps are gushing. You got a lot of natural gas coming out there, and that's what they do. When crude prices go up, they'll start turning on more wells, and then you have more supply of natural gas coming out too, and natural gas prices go down and vice versa. So you get this to go up, natural gas should go down, and I highlighted for you recently that natural gas, you could take a shot, and it hasn't gone anywhere. We're right there at this downtrend line. Now this is ready to pop. You had at this recent low, as I highlighted, positive divergence, but I can see about equal odds that we may come on down, get that one last thrust down, extend those divergences a little bit more. In other words, a little bit bigger divergent low, then hit that nice support level there, just be a better, more favorable entry, and then pop that level. Either way, you have resistance here or a price target if you want to buy a breakout above the downtrend line. This is a great example why I always say, wait for if you're trading on a 60-minute, this is a 120-minute time frame. That's an intra-period pop, no candlestick close, only to close back down below. I'm talking about that skinny part. We call it a shadow on a candlestick. The skinny part on the top or the bottom is a shadow. When it's above, it's a wick. When it's below, it's a tail. And so anyways, a breakout above there, but then you have the BOD, benefit of the doubt, resistance, 382 right there. These are your upside targets. And again, so, if you're in it, like I said, I don't have super high convictions, but you could try to trade it there with a tight stop down there, reverse, go long there, and then add again on add to that long position, increase it on a breakout of the downtrend line, and then once you take out 380, it should run up to these targets there, maybe a fourth target around there. We'll see. So that's your update on crude and natural gas. Let me update Bitcoin. The last time I updated Bitcoin, you can click on the what do you call it, the symbol tag below this post, and it'll bring you to those. Been covering this one in videos, and gave you right here. Told you it was a really nice short setup on both Bitcoin, crypto itself, and the futures, which I'll get to in a second. We were right here, and I said sell signal to come. We had a nice big divergent high, just like we got bullish and long here, just like we were short off the highs there. Covered those, I put a Bitcoin and Ethereum longs off the lows because of that positive divergence there. And right now, like I said, it's this negative divergence. Looks like they've run full circle. So we got the breakdown I was looking for. That was just a few weeks ago, last update there. Yeah, no, I actually updated once more since then. So we're coming up on that first target zone there. We're hovering a little, we're in this little sideways range right here, a lot like the stock market moving sideways recently. And these are still the other potential targets. And we'll see how this starts to play out. I may add some longer term targets on this one as well. So that was the actual crypto. These are the futures, BRR. You can also trade the micro contract, MBT. The BRR size is pretty big. It's about represents about 525,000 per contract. So it might be a little rich for some people's blood. And that's what MBT comes in. It's I think it's like 1/10 or 1/20th the size, but it trades off the same price levels. So there's that. When I highlighted it for you, we're right here. I told you a sell signal would come in a breakdown below there, which we got. So far, you're good for about oops, I didn't mean to move that trend line. That's not what I meant to do. Or price support level, I should say. From the breakdown, I just need to do this to measure. It's the grab feature is so sensitive on this, and there is an adjustment, but it just doesn't work well. That's nothing much, about a 5% drop so far since the breakdown, but let me put that line back there. That's resistance right there now. And like I said, Bitcoin's consolidating here. First target's still right there, second target and third target. Yeah, these are the targets I gave you on the... So if these are hit, that's going to be about a 6, 10, and 14, 13% drop right there. And if you don't trade futures, you only like ETFs, IBIT, we've just been slaying this thing. We were short there, hit my third final target. I had a total of 6, but I covered this quite a bit as we were dropping into the April lows, and told you that I reversed everything, all positions, including this, from short to long. And then I even laid out price targets. I give you the targets on Ethereum, ETHE, and all that. And that was based on the technicals and what was going on in the stock market at the time. And so we had it. That's the run. So we had a nice run up. and we came full circle. We put in, just like I showed on the futures, from a divergent low, which is bullish, and then the breakout of the downtrend line and back test. We had a nice run up, and then we put in a divergent high, and then we had a sell signal recently, and that's it. Still on a sell signal. Any bounce back to 61.63 would be an objective out on our new short entry. This is your first target zone, second target zone, third target, etc. And remember, I'm watching Treasuries very closely. Like I said, we're coming off, this was a test of the multi-year, multi-decade highs and yields, which also come correlated with a test of the recent lows. This is TLT daily. I know it's a busy chart. Here, I'll turn off all those lines. So that's when yields were pushing the limits. And then we also, at the time, we put in, technically induced. We had a positive divergence. We broke out of the downtrend line, but there's quite a bit of resistance overhead. So it wouldn't surprise me if this is the end of the run for that breakout. It will fall. If it does, it's going to be well shy. This is the measured target. When I do this right here, what I'm taking, this is your bullish falling wedge on the 60-minute chart. If you take the widest part of a wedge, add that to where wedge breaks out, gives you a measured target. So that would take us somewhere up there, right? So if this falls shy, that's going to be very bearish. It's also going to be what we call a bull trap, all those that took the breakout. But again, like I said, I don't have a position right now. I'm watching it for a break of those recent lows. As I think I said, it will have a definite impact. And if and as we go every tick down below the recent lows on TLT, again, will be a breakout to new highs and yields. So every tick you incrementally add to the bearishness for the stock market. Again, if it's a little spike and a retest, the market may not freak out. It could, but farther you get away from that. In other words, the higher yields go into multi-year, multi-decade new highs. I can all but promise you it's going to put the brakes on the stock market very hard. And that's it. Let's recap this one here at 27 minutes. Like I said, nothing that happens today I think is relevant in the stock market with those big economic or the employment numbers out tomorrow. So let's see where we go from there, where the market, how the market reacts to the numbers, where they come in at. But again, the trend has been clear to me on that, and so it should. Just like commodities are also ticking up higher. This is DJP. This is what I've given you for years, my real-time inflation indicator, because it's the best we can use. Housing is the biggest component of the CPI, Consumer Price Index. However, housing, the data is so lagged that there's no real-time indicator. You can look at Zillow trends and all that, and the trends have turned, don't get me wrong. They've turned. I covered that the other day, I believe. But this is more of a real time. And so all these boxes are month to month. And you can just look at it. This is when, this is DJP, a broad-based commodity ETF. So we had runaway. This was the Biden inflation, the Fed being in denial, transitory. Oops, we were wrong. Then inflation, had a natural, abatement there. But again, by all metrics, this is it. This shows persistent prices. So the rate of inflation, a lot of people tend to forget that when they report the CPI, Consumer Price Index, or the PPI, or any of these, that's the increase in prices. So these elevated prices that we have, just like interest rates are persistently high, they haven't been going up lately, but they haven't been going down. They notched up and they're staying up. And if you turn off all these lines right here, this is just showing you the April. This is be the next, it's about a flattish from month to month. But if you turn off all the lines here, okay, you're hearing a lot of cheering on Wall Street that inflation's, over now and everything's back to normal. But you can see here we peaked, troughed, I'm sorry. We went sideways for a while, right? But you can see now, right, what I'm drawing here. The definition of an uptrend is any security making a series of lower highs and higher highs. I'm sorry, higher lows and higher highs. And especially if you break out of a trading range. So that's it. So keep an eye on this because that will further handcuff or crimp what the Fed can do. Again, I favor and I expect rate cuts. I think the odds have been. I know they have been and will continue to increase, especially if the job market rolls over on Fed rate cuts. But as I said, market needs to be careful what it wishes for, because if it's Fed rate cuts because the economy, the jobs market's all of a sudden coming on the skids, a recession's gonna, odds are going to go up significantly. And we've already had one contracting quarter of GDP. The old technical definition is two contracting quarters, negative quarters of GDP growth. Of course, the NBER gets to, in their infinite wisdom, with no set formula, just arbitrarily declare what is and what isn't a recession. But again, Wall Street's gone off the old two contracting quarters of negative GDP growth. So we'll see where that goes. And all right, let's just sit tight, wait and see what the employment numbers look like, and then each of you can decide, if you do have a position in the equity indexes, what to do there, whether to go long, add to your longs, go short, add to your shorts, or stop out of either of those two. This has been Randy Finney with Right Side of the Chart. Have a great day.